One thing that has become table stakes among buyers is having a very strong organic growth rate. If you are entering the market as a buyer and you have an organic growth rate excluding market of 2 or 3%, people are going to say, well, what's wrong with you?
Hey folks, it's 2026 and we are back with a special episode of Marketing Matchup. Now I broke my own rule. I have CMOs and executive VPs of marketing from the industry joining forces on these podcasts to give ideas, but I thought it was really important. M&A has never been more in the spotlight, and the organic growth as a fixture of M&A discussions has never been more present. So who better to help dive into this issue and how it's seen for the deal-making world than an attorney and a deal maker that actually have known each other in the past. It's also uncommon for these things where people know each other. I'm delighted to have Corey Kupfer, the founder of Kupfer Law, and we have Jess Polito, the entrepreneur and the brains behind Turkey Hill Management. Both of you, great to have you on the show. Thanks for joining us.
Great to be here.
Pleasure to be here. Thanks for having us.
So let's do this real quick. I know you both. You know each other. Jess, full disclosure, was on Corey's podcast a while back. But as we get into this, I think not everybody in our audience knows who you are. So Jess, go first. Give us a quick primer on who you are, how you got to the seat you're at currently in the industry.
Sure. Well, it's the only thing I've ever done. So I have been an M&A advisor, investment banker, serving the wealth and institutional asset management industry since the ripe old age of 21 when I graduated college. So I started Turkey Hill about 5 years ago in order to serve the independent RIA space, looking at M&A a little bit differently, more from the partnership side of things rather than the transaction side of things. So our firm does not charge a success fee, which is typical among other investment banks in the way that they get paid, with the hope that if we can be paid like a consultant, we can also provide services like a consultant, sit on the same side at the table as all of our clients. And we've been very fortunate to have a bunch of people buy into our vision. We signed 16 purchase agreements in 2025. I think we have 6 or 7 announcements coming this month, January of 2026, and hopefully that kicks off a robust 2026 for us.
And Jess, I'm not going to ask you to give names, but later on the podcast, we're going to come back to some of those deals you help facilitate to get a glimpse of what's been working inside those firms in terms of growth that's helped lead those discussions. Corey, please fill us in. Tell us how you got to where you're at and how you're involved in the M&A space in the industry.
Well, I've been practicing law for 40 years, which is kind of crazy number to me. Been doing M&A for 39 of those. Actually, 39 and a half. My first year, I split time. And I've been doing stuff in the RIA space for 28 years. We are one of the leading firms in the country in terms of breakaway brokers. We've done many hundreds of those. The first one 28 years ago. And then we do a huge amount of corporate capital equity structuring in about 2/3 of our business in the RIA space, but we have clients all over the country and all over in other industries as well. And then obviously a huge amount of M&A over the years, especially in the last 5 years when the PE money has come in, the M&A market has increased, and we've had the pleasure of doing a number of deals, and we have some ongoing deals with Jess and her team.
Oh, I was just about to compliment you and say, unsolicited plug, Corey's a pleasure to work with.
Well, and I think it's important in these heady times where there seems to be a deal announced multiple times a week, be able to get along with the other players in the sandbox. So it's great to know that you work well together. I think one of the things that as we dive into this conversation today, most people looking at the world of M&A don't necessarily think it has much to do with organic growth. I've looked closely, as you both know, we work with some of the acquirers in this space, and in that work, nothing fuels discussions faster than either finding a firm with a good path on organic growth or something that could be exploited for organic growth. And so I'm going to start with Jess. Jess, when you take a look at these things, you're sitting down with sellers only, as I understand it, and you're looking at sort of what their playbook's going to be to market themselves. At what point does the topic of organic growth come into the discussion when you're thinking about how to position them and work with them to get them to where they want to go?
Yeah. Well, I mean, look, by the time people come to us, what's been done has been done. They're ready to sell their companies, and either they have grown organically or they haven't. I think there are statistics that fly around all the time that most RIAs are actually shrinking if you exclude market. right? So even those that are able to grow at, 2, 3% a year outside of market are looked upon favorably by buyers in the space. That's not to say that there isn't a universe that exists that are interested in partnering with firms that are not necessarily growing, that have kind of hit capacity, that are running lifestyle practices, that are looking for more of a succession type of play. Those types of firms command a completely different set of multiples than those that have actually put thought around organic growth. And I don't mean, robust digital marketing, the kind of things that you would see out of like a 35, 50, $100 billion firm. What I'm talking about is, you know, actually telling their advisors, hey, when you're talking to your clients, ask for referrals. See if they have other money you don't know about, like that counts as organic growth. Very much so, sponsoring the little league games locally, it all counts. And those firms command different multiples um, than the ones that don't. It's not right or wrong. It's just, there is a premium that is associated with firms that have the ability to grow beyond by accident.
So, Corey, what's your experience with that? As you take a look, and you're obviously at a slightly different position at the deal table than Jess might, but what's your experience when you look at those factors of firms that are showing up at the table, either have been successful in growing, or maybe that are struggling and realize they need to join someone else to be able to get the job done?
Yeah, yeah. So we have an interesting perspective because we represent buyers and sellers. Obviously, there's been more sell side deals because a lot of the buyers are the big PE backed aggregators that use the usual firms on the buy side. Although we've represented some of them, but we see it from the buy side as well. We certainly represent some of the next sort of rung down, and we've helped with some of the big PE backed aggregators. And then because we represent RA firms ongoingly, right from their startup. We also see them earlier than often Jess does, right? Because we're representing them on general corporate stuff and other growths. Maybe they've done their own tuck-ins, things like that. And I do. I mean, obviously, it's not what I do for a living, but they often will talk to me about what are the factors that increase enterprise value, or the factors that make them most attractive to more buyers. And I'm certainly going to mention organic growth as one of those factors. The stats I've seen, and there's a bunch of different ones out there, is that the average RA firm outside of market's growing 3 to 4%, which means that the few that are growing more than that means that there are some that are not right, that are not growing at all. Right, that's the average. So if you can have organic growth outside of market that's higher than that, yeah, I mean, you're more attractive, you're getting higher multiples. And listen, this is sort of a slice of the theme that I always talk about with my clients. And we do these whiteboarding sessions even for firms that want to start buy-side M&A programs. And one of the things I say to them is, listen, everything you do to increase enterprise value, that make yourself more attractive, more valuable, and getting you more terms on the multiple is also a best practice for you until you sell, or if you never sell, right? Whether that's having great organic growth, whether that's building, great systems, whether that's, having great team and equitizing your, or incentivizing your G2, like those are all things that help you while you operate, and that will also, like higher organic growth, put you in a better position if you do want to exit at some point.
So,
That's
go
a
ahead,
real
Jess.
good point. We represent sellers, but by virtue of representing sellers, we meet with a lot of buyers. And one thing that has become table stakes among buyers is having a very strong organic growth rate, right? To the point where if you don't, right, if you are entering the market as a buyer, right, and you have an organic growth rate excluding market of 2 or 3%, people are going to say, well, what's wrong with you? So when you think about larger firms, the 3 to 5 billion, maybe just starting to think about entering the M&A arena, maybe they just got capital backing, maybe they're looking for some. One of the things to look at internally before you decide whether you're ready to play with the typical players in the M&A space is, am I growing? Do I have the ability to grow? Have I invested enough in growth? Because that could be the difference between someone choosing you and not, right? Like if they're rolling 30, 40, 50% of the deal value in equity, they want to make sure that their investment that they're making into this new illiquid entity is a better option for them than just maintaining their current illiquid status in their own business, right? So if the firm that's selling is already growing at 5%, they want to make sure that the firm that they're rolling into is growing at 10%.
You definitely want to make sure that you're moving upstream when you're making a move like that, particularly as it comes to another area I'm sure you will have comment on, which is in making sure when the deal structure and what the earnout looks like, what the environment you're going to be operating in on that side. And a lot of firms have made a point of not just getting succession-minded advisors, but also wanting to get those advisors maybe mid or late career that say, hey, I have 7 to 10 years to make a big push. I want to do it inside a better chassis. What are some of the things you're seeing from the deal structure side? Sorry, you, Corey, that helps sort of align these deals for growth. So the advisor comes in, yes, maybe the acquirer does have a higher growth rate, but also what systems are in place to help those advisors come in to maximize that potential that's afforded by that larger, more scaled organization?
Yeah, yeah. So I'll answer that from 2 points of view. I mean, one is definitely those bigger buyers are touting, most of them are touting their higher, organic growth rates and saying, hey, that's one of the reasons you should join us. A couple years ago on my Deal Quest podcast, I did, I had 9 or 10 of the top, serial acquirers, aggregators, CEOs on, and, to a person, whether it was Marty Bicknell at Mariner or at the time Bob Oros at Hightower or Matt Cooper at Beacon, every one of them mentioned their organic growth rates and the ability to help advisors grow more quickly and all the marketing capabilities and support and brand recognition and all the things that they. So that if you can't tout that as a buyer, like Jess said, you're in trouble. In terms of structuring, I mean, listen, every deal's a little different, but if you want to take sort of what a normal deal structuring is, right? There's going to be some amount of cash and equity up front. There's going to be some that's over time subject to a retention, usually these days around 2 years, to be able to retain, right? So the first thing is, you better retain what you brought in, or else you're going to take a haircut. And then there's going to be an earnout that has a growth CAGR on it. Something in the order of 15% a year. It could be lower, it could be higher, but let's pick that number, right? So, if you are coming in and you are growing at 5% right now, and you have a 15% growth CAGR, you better believe that that buyer is going to actually help you, right? Because you haven't figured out how to grow at 15% pre-deal, right? You're only growing at 5, just in my example. You better believe that joining that firm is actually going to help you hit those numbers, or you better be doing a deal assuming you're not going to get that money, right? And that's something that, I talk about, Jess talks about, when they talk about aggregate deal value, right? You want to strip out the earnout and look at it as a separate piece, because then that's not the value they're paying you for your current value. That's the value they're paying you for growth. And you better believe that platform, that firm, that the combination of, their marketing abilities or whatever, and also potentially freeing you up, right? That's another value proposition that they'll say. They're going to free you up from a lot of the stuff you have to do so you can actually concentrate more on bringing in more business. But you have to buy into that value proposition and be confident you're going to do it if you want to get those earnouts and hit those growth CAGRs.
The other side of this issue is once firms get past a certain point, maybe the LOIs are signed, the deal hasn't been finalized, but you're somewhere along the path where you think you found your partner. I'm curious in your roles and place at the table, and Jess, maybe you see it differently than Corey, but I'd like your input. At what point do the growth and marketing people engage? Do you see CMOs or executive VPs of marketing or chief growth officers show up to the table in advance of close to making sure, like, the onboard that? And has that prevalence changed in recent years?
They're present almost from the start. So what we find in our processes is we will have first round, Zoom meetings, right, with all of the prospects that are a part of the process that we're running for the seller. And typically the chief marketing officer is not present on that call, but often they get talked very highly about. So what we see a lot are like follow-up meetings that get scheduled where it's like, okay, well, show me this like wizard, pull the curtain back and let me understand who is behind your 20% annual growth rate, right? If that doesn't happen, then they are certainly highlighted in the next round after we've received preliminary proposals. Once the seller has narrowed it down to their top 3 or 4 favorites, and we're meeting with these firms, the potential partners, in person, we'll spend an hour with the chief marketing officer, going through everything that becomes available to these sellers once they join with the partner. And those are some of the most enjoyable parts of the meetings, because it's like, yeah, we can talk about how our investments are aligned or not. Like, yeah, we understand that we all care about our clients. That's why we chose you, right? But like, show me how you can create a landing page for my niche. Show me how you can, facilitate local, like, client events, right, for me in a way where I don't have to spend all of my time and energy, but I can kind of reap the benefits of the clients that come through as a result. Like, teach me how to ask my clients to refer their friends. Um, those are awesome. We love those meetings. And that is typically the launching point to help sellers get over the hump that Corey was just talking about, where, okay, if I was growing at 5% a year, maybe I begin to achieve my earnout by growing at 5% a year. But in order to maximize it, I have to grow at 15% a year. Well, I have one person telling me, okay, well, we're going to take over your back office and we're going to take over, your compliance and free you up from the hassle of running your business. That's great. That frees up your time to, start bringing in new clients. But how are you going to bring those in? It's through the marketing capabilities of the partner firm. And it becomes a lot more tangible when you actually couple the buyer's existing growth rate with, you know, looking at their capabilities and actually understanding what's available to you if you want it. Often that's when the process starts to become very exciting for the seller, because it takes something very nebulous and kind of like negative almost of, well, they want me to grow at 15% and I've never done that before in my career. And it turns it into this like reinvigoration of, oh my gosh, like I haven't felt this way about growing my business since I was 35 years old. Like, this is incredible. And that I mean, look, I know this is a marketing podcast, so I'm not trying to like, tunnel vision here, but it's a very important part of understanding the vision of what the other side of a deal looks like.
So, Corey,
And
when you look at things from your perspective, how would
yeah.
you weigh in on that?
Yeah, I mean, 100% aligned. And also, I think there's another piece to this, which is we haven't talked about, we've been talking mainly about earnouts, the founders, right, the equity holders. But there's also a big piece of this with G2 and G3 advisors, right? So, one of the challenges in deal structuring and, just practicality in getting deals done is you have, especially if you have let's say a G2 who's not equitized, is not, or is under equitized, and is not going to get the full benefit of the value they bring to the firm. Maybe the clients take control, the business they've developed in purchase price. And there's a lot of ways outside the scope of this podcast where we can try to address that, right? But one of the things, even if you can address that, if they have a mistake, somebody who's 35, right, and has 20, 30 plus years in the industry is evaluating a deal very differently than the 62-year-old or 68-year-old founder, right, because and they're going to say, hey, especially if the more successful, the rock stars are the ones who are most challenging, because they're sort of like, wait a second, I'm cutting off my upside here, right? Yeah, okay, maybe I'm participating in some of the purchase price, hopefully at least. But what am I going to get when I grow? I can grow organically on my own at at these rates, right? I'm a go-getter, right? I'm young, I'm out there, I'm hustling. So, the 15% growth rates that you're going to bring me up from 5, I've been growing. I think I can do that on my own. Why should I do a deal, right? So it becomes even more important for the buying firm to be able to convince the G2 that the support that they're going to give on the organic growth side, and by the way, then the comp or other deal structure or additional equity piece or whatever that it is that's tied into that, is going to be attractive to somebody who's a lot younger and feels like they got a lot more gas in the tank and a lot more ability to do things on their own and a lot longer, time frame. And the downside is, if you can't convince those folks, sometimes they leave, right? Or they have leverage in the deal negotiation because they control 20% of the book. So you better figure that out for G2 as well, and that organic growth piece is sometimes even more important to those folks than it is to the older founders.
Well, and Corey, you hit on something I think is really worth discussing here. We know that just generationally across most businesses, professional services, financial service, whatever they might be, different people at different points in their career market and connect differently. They have different pursuits of growth. I think, and that's one thing I've been saying for about 10 years, that marketing every year gets more and more fragmented, right? And if Corey, you do awesome with digital marketing, I might say, hey, I've killed it with golf outings, and Jess says I have this niche marketing group that's crushing it, and they're all right answers. It also makes it more challenging to scale and repeat beyond the individual advisor's preferences. So I would back in and say, all right, you see this and you look at the complexion of how firms market themselves and where there might be niches or firms that are known. Do you ever find yourself in situations where you're helping firms get married, as it were, because the acquirer has a great women's initiative and the seller happens to have a 70% female client base, things like that. What have you wrestled with? Has that been part of the magic in terms of finding mates?
I had one of
Yes, you're
those
smiling
yesterday.
like you've done this before.
I had one yesterday. It's very interesting because there's a lot of alignment among just like the need for niches in this space, right? Like sellers are very proud of the niches that they've been able to cultivate. And buyers look at niches and they're like, let's go, we know how to market to a niche. Like you tell us about, the doctors that you have in the Kaiser network. Like you tell us about, the like scuba diving professionals that you whatever it is, right? Like we will find a way to market to them because it's a tangible group of individuals that all kind of have the same whatever it is, like pension plans, deferred, like RSUs, whatever it is. Like we can make that push. You just have to tell us where to push. Women's initiatives are huge right now. That should come as no surprise, right? There are a lot of female-owned RIAs that are looking for buyers that actually kind of put their money where their mouth is with women's initiatives. So it's not just you know, uh, like the male CEO is saying, "Well, we like women," it's like, "Well, what are you actually doing? Like, are you working with divorcees? Are you working with the female head of households who are the ones that are actually the breadwinners? Are you, doing seminars for, 25-year-olds who are just getting started in finance? Like, kind of show us how we can take our female clientele and tell them, well, they've really amplified what we've been able to do on our own as a, $500 million firm. Now you have all of these resources available to you because I've spent so long cultivating my network of female clients. Like, I'm not just kind of like leaving you out to dry. Um, Everyone loves a niche.
Well, that's good perspective, and it's funny that you just did one of those yesterday, Jess. And Corey, have you seen that? I mean, in my experience, I've had clients tell us, "Hey, it was a great fit. They were already using the same tech stack, and it was really seamless behind the scenes." But it's not very often that people will say, at least in my opinion, that that's the first thing they're looking for. They're marketing the same way. But have you seen that show up, or there's like kismet where you find hey, they both work with telecom executives, and how does that help deals shake out in terms of the marketing
Uh,
aspect?
yeah, listen, I think that's a factor, and one of the things that it's interesting. Like this stuff is not generally reported, right? What's reported is the numbers on the deal, and you know this amount of AUM or this amount of revenue, or or whatever, right? And listen, Jess sees this even more than I do because in her role, she's the one who's really shopping, and providing the access to all the different buyers and helping them cull down. Obviously, I get because unlike other lawyers, right? I've been doing this for so long. I've done so many deals. I know all the players. I helped design some of the buy whatever. So people will ask me generally. And yeah, I mean, I think, listen, this is the beautiful part of the stage of the industry we're in right now. Um, sellers have a lot. Any decent, even a mediocre seller, frankly, has a lot of options. But certainly, a quality seller has a huge amount of options. So you really get to, if you're smart, you get to choose as a seller, and you should be looking at all of these factors. And most of them, because listen, frankly, I'm not saying there isn't differences in the money. There certainly is, whatever. But there's a lot of sophisticated buyers. They're underwriting deals in a certain way. You're not going to have a several multiple, you might have a turn here or there or whatever. So the money's not going to be, there's some differences, but it's not going to be like, oh, somebody's paying me double what, this other person's paying me. So these other factors like, hey, is it really a fit? Do they understand my niche? Do I like their culture? Are they really going to help me to grow, organically, or by the way, even inorganically? Maybe they're going to help me to bring on other advisors depending upon their model, whether how integrated it is, or whether I'm going to be running my own sort of, thing. These are all factors that they're definitely, I think, the smart ones are taking into account. And and again, depending upon their stage, I mean, listen, if it's a retirement deal and they're rolling out in a year, or two, they're much more concerned about making they hit their retention, and then maybe their G2 that's more concerned about the growth, later on. But I do think it's a factor in terms of the smart ones that are doing due diligence, and it's something that they should be looking at. And again, I think it's in deal structure, it's those growth CAGRs that drive it. Like even if they weren't um, focused on that before, when they look at it and they say, I've got to increase my growth by X to hit that CAGR, that makes them start asking some more specific questions on how they get there.
Joe, I think it's almost less about, do we have the same niche, therefore you know how to market to it, as it is like, do you, buyer, have the ability to market to niches? Like,
Yeah.
if you can show me that you have marketed effectively to scuba divers, then I believe that you can market effectively to, whatever, tenured professors, right? So I don't think
Yeah.
it's not the same kind of matchup as it's like, are we all using Tamarack? Oh my gosh, that's great. It's more kind of like, well, if all of your organic growth has come through like San and Waz, right? Then my niche with tenured professors probably will still be up to me, you know?
Jess, you just walked into my next question. You mentioned
Great.
this is perfect. So here I am, coming back from the Christmas, doldrums, whatever you want to call it, and I see BNY Pershing going to do a referral program, and then Goldman through their ACO units doing referral programs, and then last quarter of 2025, there's all this commotion around Schwab because they changed the level AUM level of participation. It's now 26 basis points versus whatever it was in the past, and so lots of buzz around that. So when you're looking at a deal, and now some of these firms that have sold themselves, I had a client of mine, few billion in AUM, sold themselves, and they had a good chunk of their money coming from SAN. And that has got to change the calculus in terms of how they get paid for their business. And so it's a two-part question. How big of an impact is it really in terms of if you're getting some of your growth from there? And how does it change how you might guide firms to think about, okay, you think you might sell in 3 to 5 years, what would you be doing as a deal maker or the deal facilitator? Your advice would be in terms of how to think about where to source your new business from. And Corey, you're nodding along. What's your take on that from a deal structure standpoint when you see revenue from those programs?
Yeah, listen, it's really interesting. I mean, there's always a challenge. I mean, listen, I'll answer this in a weird way because I'll step back, right? Like 2/3 of our business is in the RA space, right? I love that. Like being known in a niche, having key referral sources, whether that's the custodians, right? Whether that's the investment bankers, and deal professionals in the space, like for a firm like mine is phenomenal. At the same time, I work really, really hard to make sure that I am marketing and trying to get referrals and building relationships outside the industry, not because I mean, this industry is a rocket ship, but I don't think it's smart to be dependent upon one industry, one source, one whatever, right? It's the reason why firms that have an over concentration, right, with a couple of clients that represent a huge percentage of their of their business are either going to get lower multiples and or different deal structures that are going to protect the buyer, right? Because there's much more risk. So with that, set as a background, somebody who's getting a huge amount of their, business from the SAN program, for example, right? that's a high. Well, first of all, it's lower margin, right? Because there's a share. Second of all, not all revenue is equal, right? Deals are done on multiples of EBITDA. Um, Second of all, it's riskier, right? Because listen, the referral programs have been known to cut firms off, and by the way, it may not even be you. It may be your firm that they get unhappy with, and they're no longer going to work with so and so here, or they change their minimums, or so there's less control over it. Listen, it's one of these things that's great and bad. Like, if you get in and you're known well, as a great referral source for one of those programs, you can get a lot of business from it. But there's also the risk of being overly dependent upon it, of potentially losing it, and it's lower margin.
Well, it
I
goes
would
back
say,
to the business school acronym cost of goods sold. Like if you're if it gets if you're taking a haircut on your revenue before you even pay your staff, it's a tough place to be. Jess, what do you observe in the deal making process when you see firms that are dependent or maybe absent, maybe they're not participating? I mean, does it like how does it change? Is there an opportunity to say you haven't even tapped these things yet? I'm just curious to see how that plays a role.
that's a really good question because um, I would say a big red flag is sitting down with a buyer and having the entire conversation really dictated by their relationship with Schwab or Fidelity. And, it's like, and the reason that we're interested in you, seller, is because you open up a new market. So we'll have one of our business development people come to your market and then we'll develop a new relationship with, Schwab or Fidelity. And it's like, okay, but what happens if they continue to call and you don't make the cut? Right? Then you are dead in the water from an organic growth perspective. And, you have all this debt on your balance sheet from the inorganic growth that you've been doing. And you better hope the market continues to work in your favor, right? Like that's bad. What's funny is that on the other side of that, where you have maybe like a 10 billion, $15 billion firm that is more recent to the acquisition scene, that is not on San Was, a seller becomes so trained to hear about the referral networks that when they ask if they're on it and they say no, they're kind of like, well, what's wrong with you? Like, why don't they want you, So I think somewhere in the middle is really just kind of like the sweet spot for where we are in the market today. It doesn't mean forever, and I think you can justify, and people do because it's their businesses, being further on either end of the spectrum. But, if you kind of think about it in thirds, you kind of want to see organic growth coming from, up to a third referral networks, a third inorganic growth, and then a third, like, really kind of more like grassroots organic growth. So kind of the same things we've been talking about, right? Like referrals from clients, digital marketing, client events, things like that.
So one of the things you take a look at is as these firms are diving in, and I tell them all the time, you really can't predicate your business development around the referral networks unless you have organic growth. It's really a troubling thing when they think that's going to be the cure-all. And so you look at that, and then on the flip side, it's like, all right, well, you have these levels of participation with the referral networks that could dampen your valuation, frankly, how much that revenue is really worth, or how much your future growth is going to be diluted in terms of the overall revenue. The flip side is, when you're looking at a firm that isn't participating there, you have to think about, if they're not spending money through a revenue share with getting referrals, do they even have a game plan or a program to say, all right, I'm willing to commit X% of my revenue to support new business? And I think one of the things you see, and we've seen on both sides, the acquirers as well as firms that will be acquired eventually, just don't know yet, or they are in the process of shopping themselves, is that very few of them can escape the fact that the organic growth pressures are only increasing because of the M&A dynamic, where if you want to be thought of as a sort of the belle of the ball when it's time to market yourself, you need to have that going. And I look at it now, there's another element here. One deal maker told me, I'm curious to get your reaction on this, that organic growth has to exceed the cost of capital to do the deal, to even have a discussion in terms of what they think the firm can do above and beyond. I don't know if that makes sense to you, but let's just say you're costing you 6%. You're hoping that firm can add 6% to their growth stack in that first year to start paying yourself back. may be fuzzy math, but the idea is there is pressure because that capital is costing you something. How do you see that show up in conversations in the deal room? Does it may not come out that way, but I'm just curious to get your reaction where that process comes around the pressure associated with organic growth and knowing that some of these firms are on the hook for to pay a return to an investor to surpass that. So what's that like in the deal room?
Well, I will say Corey probably sees more of like the sausage making than we do since he represents buyers too. Like we'll never have a buyer come out and tell us, well, you told us EBITDA is this, but this is actually, the EBITDA that we're using internally. And here's where we plan to save money. And this is our internal multiple, right? But I think fuzzy math is a good word for it, right? Like the multiples in the industry are so high right now that the only way to justify paying multiples that we've never seen before is like, well, I guess two ways. One, multiple arbitrage, right? Like if you're buying a firm for 11 times and you value yourself at 20, right there, you've made up 9 times. But the other way is, well, what is this business going to look like in the next few years? Am I really paying 11 times or am I paying closer to 6 or 7 times because, they have been growing and, I can stomach making back my investment in 6 years, right? I mean, you can't buy a firm for 15x under the assumption that it's going to take 15 years to recoup what you've paid, right? So I think philosophically that makes a lot of sense.
So, and Corey, using Jess's words, you see how the sausage is getting made on both sides. Give us some illumination in terms of where that comes in and how those discussions happen.
Yeah, I mean, listen, they're definitely firms are definitely underwriting deals based upon a fundamental. I mean, this is not rocket science. They're looking at, okay, at what point do they get a return on investment after they pay out their the purchase price, right? For them, just like the growth CAGRs, portion of it is separate. The earnout portion is a little separate from the buyer's point of view. From them, it's separate from from the seller's point of view, it's separate from the buyer's point of view because, all right, they know they're paying for growth there. That math works, right? So now let's look at what they're paying, outside of the earnouts, whether that's upfront, cash equity or on the retention over time, whatever it is. All right, and let's amortize that out. And just as right, I mean, no buyers advertising these deals over 15 years, right? They want to be able to start making money on that, in maybe a third of that time, right? And at the same time, listen, different buyers are different, right? And part of it really depends from the buyer's point of view on what their objectives are, what their goals are, because the multiple arbitrage thing, is potentially huge. Now, I've been around a long time, and I've seen a lot of roll ups. Right? Nobody likes that word because they went bad in the '80s, right? But I was practicing in the '80s, so I'm familiar with it in other industries, right? And listen, what you see by history is that there are some firms that do it well, hit the market right, all that kind of stuff, and that multiple arbitrage can be unbelievably huge. And then there are some that aren't as successful, and that promise doesn't pay out, right? So but if they are, the good thing about this industry, unlike a lot of other industries where there's a multiple arbitrage game being played, is that this industry, the deals are being underwritten. I mean, this is an industry that could, even if they couldn't sell at those higher multiples, they can, I mean, it's a good cash flow industry, right? And unless there's a huge black swan event and the market goes down, crazily, and the firms have been, listen, let's face it, the buyers have generally been better, not across the board, but generally been pretty good at the organic growth game, right? And especially with the push from private equity to integrate into a single brand, right? You see that over and over again, right? So now, I mean, Focus is a great example, right? Used to have all these different brands out there, and that's harder to market on a national level. Now they're rolling stuff in. Hightower's doing the same thing. Then you have firms that have always had a single brand, the creative, plannings and the Mercers and whatever. So, there's a move towards a model that makes it easier to have organic growth, to build brand equity, to be able to market that brand equity nationally, right? That will benefit, everybody.
Well, you talk about the brand assimilation that a lot of these companies have brought about. And there is a contention. And you talk about the multiple arbitrage. Part of the ways to actualize that is, okay, we're trading at 18 or 20 times and you're trading at 10 or 11. We're going to do that. Part of it's also getting the alignment of the business where they're under one brand. They're seen as providing a unified service. And so you're seeing a lot of that. And that's another tie where it goes back to the idea of, can there be a household name brand like this? And all these firms are aiming for that. And I think from a valuation standpoint, obviously, if you're selling cola in America, you're going to get a lot more notoriety and premium for Coke than you are going to be, Joe's Cola Company and Ocean City, Maryland, right? It's like to be a different game. Just the same, I think there are people that are, they think about marketing their business. They talk about it from the standpoint of, well, I want to do something where I get a second bite of the apple, where I participate. Is that, are those that are contributing to organic growth on a sell side that move to the acquirer, are they participating? Well, what percentage of these firms are really offering those growth-minded advisors that join a chance to participate? It could be, I guess, maybe on a small diluted basis, but what is that like today? And are they given more access to participate if they have a track record of strong growth?
I would say the majority of sellers fall into the camp of, I'm overwhelmed. I don't want to run my business anymore. I just want to be an advisor. And I think unicorn might be too strong of a word, but the firms that are looked very favorably upon by buyers are the ones who, like, not to paraphrase JFK, but like, are not like, what can the buyer do for me, but what can I do for the buyer? Right? So like, I want to grow. I want them to help me grow. This is as far as I've been able to go on my own, but like, I have a vision. I have a hunger. I have a desire. Like, let me have an outsized role, not just to benefit myself, but to benefit like the overall growth of the firm that I'm taking equity in. And again, kind of going back to the beginning of this conversation, like there are market premiums associated with people who have that kind of like vision, because you just come across them less frequently than, the accidental entrepreneur who's very tired of running payroll. So when you have that kind of personality, they match up very well with growth-oriented buyers. And then it's like, those are like very fun meetings to sit in, because they're like, well, we can do this. And what if we did that? And then we could do this together. And they're like, oh my gosh, I need to put you in front of this person. And it's like a very exciting conversation. That's very different and relatively unique compared to what a lot of conversations look like with buyers and sellers. So yes, there is definitely an opportunity if someone wants to participate in, the overall growth mechanism at a buyer. Yeah, they're welcome. They're welcome to join.
We covered a lot of ground as relates to the referral networks, equity participation. One of the things I want to come back to is the idea that there are tactics that firms have done to lure or bait potential buyers or potential sellers. And I want to share an anecdote with you. We were hired by a firm 2.5 years ago, where one of the things that I really wanted to do was build an advisor ambassador program where we would help showcase that firm's advisors, particularly the ones that were onboarded via deal, to make them look like those individuals were bigger, better, more rock star advisors, as a way to show, as opposed to tell, advisor, when you come join us, you're going to have a bigger, better, bolder existence. And we built this program to a point where this firm's deal making just accelerated. And so the proof was in the pudding. When you think about that and utilizing marketing and growth as a bait, have you seen that done well? Have you seen that be something where you feel is repeatable? Or do you feel like that meets the psychology of some of the advisors that you're helping market their businesses? I'd love to hear. Corey, you're nodding along here. What's your take on that?
Yeah, listen, I think we need to take a step back to a very fundamental thing that underlies what you're talking about, and that is, so like I mentioned before, I do these whiteboarding sessions for firms that want to become buyers, right? Not they're going to do one deal; they want to create an M&A program, right? And like I've done 4 in the last couple of months. Everything from an existing RIA firm to a fintech hedge fund folks who want to come in and buy, to a UK wealth management firm that wants to come to the US, to a family office single, that wants to come in. So like everybody wants to get into the game, right? And the first conversation I have with them, and this is especially true for the existing RIA firms, right, who say they want to become buyers, is, I take them through a process which may seem unusual for a lawyer, where I'm starting out with why, okay, who are you targeting? What's your value proposition out to these advisors, right? Because it's highly competitive, right? Why would somebody come to you? And, because you're nice people and you care about your clients is not a value prop, right? So, what you're talking about is like, levels above the fundamental conversation that a lot of folks coming into now listen, like, for example, my fintech hedge fund folks, they get it. They've done that and built it in those other markets, right? They're more sophisticated in that area, right? But your existing advisors who want to become buyers, I mean, listen, the old joke at every M&A conference and with every banker or consultant or lawyer is that if you have people raise their hand, how many people want to be buyers? Well, a lot of them raise their hand, and if you ask how many people are going to be sellers, hardly anybody's going to raise it. And probably 80% of those people or 90% of those people who say that they're going to be buyers are actually going to end up being sellers, right? And part of the reason is because they can't distinguish themselves, right? So we need to start there to say, okay, and I have a lot of conversations about folks about how they say to me, how do I compete with the PE-backed aggregators? And I'm like, if you want to compete with them at their game, you go raise PE money and you play their game. But there are advisors who don't want to go to the PE-backed aggregators. They want an alternative. So if you can come up with a strong value proposition of why you're different, no, you're not competing with them at their game. You're playing a different game, right? So if we start there, then when you get, it's almost like, 3 or 5 levels above that on what you're talking about is the firms that really have figured that out in some way. Maybe they've first been able to attract advisors to feature, right? You can't feature anybody unless you figured out a way for them wanting to come to you. And listen, that could be through M&A, or I have a number of clients who you do a great job more on the recruiting side, right? Where it's not, the growth isn't through acquisitions, the growth is through recruiting, and they may have some equity programs or other incentives, for these folks to join them in an employment model. But yes, I mean, I think once they've gotten through that fundamental understanding and figured out that they have a value prop and they become attractive to where other advisors may want to join them in whatever model, then going to that next level, and featuring these folks as a way for other advisors to look and say, oh, look, if I come to this firm, they're really committed, they're featuring these advisors. I think it's a phenomenal idea. I just think it's, 3 plus levels above where a lot of folks are.
Yeah. Yeah, it's like behind you, they're playing chess and other firms are playing
Right.
checkers.
That's right.
So Jess, what do you say to that?
Well, I think Corey made a poignant point at the start of his answer, which is it depends who you're trying to attract. Like I have gotten feedback from, especially like very planning centric firms, ones that are very, very client focused, very scared that a partnership is going to negatively impact the client experience, that they're going to be looked upon differently, who will go on to a buyer's website. And if they see a tab that says like, are you an advisor? Do you want to join us? They're like, hard pass. Like I don't want my clients to think that I'm joining a firm that's like just trying to recruit people. I want my clients to think that they're joining a place that really cares about them as individuals, right? That's never going to attract that kind of seller, right? And if you're going after that seller, that's probably not a great strategy. If what you're going after is, 35-year-olds who are trying to build their books, right? And you can kind of like provide the chassis and help provide the resources, and they're going after their 35-year-old friends, and it's like a completely different mindset because everyone is trying to like grow and they're hungry. Then that's a phenomenal way to recruit those kind of people, because those are the kind of clients that they're likely serving, right? So I think there's because this landscape has become both like robust and fragmented, unfortunately, I don't think we're going to solve the solution of like what's the best way to kind of drive organic growth that fits everyone. And unfortunately, Joe, that's your burden to bear as the the face of Gregory. Um,
Yeah,
but
that's where we land.
it's also an opportunity, right? Because to Corey's point, right? It's a question of sitting down and saying, well, why do I want to be a buyer? And how am I going to attract the people that I want to be part of this business that I'm building inorganically? And then you can kind of back into, okay, well, if I know like why I'm doing it and who I want to do it with, what is the best marketing strategy to start implementing to attract those people and to kind of get to my goals?
Support your why. Well, that's a really good point, Jess. I like the way you frame that. So we're at the point in the podcast, we're down to 2 questions. I'll give you a heads up, a little primer. Our last question, if you watch these episodes, everyone, it's the your parting shot. So I want you thinking in the back of your mind what your parting shot will be for our listeners as you think about the intersection of deal making and organic growth. But before we get there, my last question is around one pocket of M&A and buyers and investors we haven't talked a lot about, which is these minority platforms. Think about it. We have Rise, Merchant, Emigrant, Constellation, Aurochs, on and on. You have lots of different kinds of buyers that are taking stakes in firms, very often leaving their brands in place and letting them run independent or semi-independent operations. And a big part of what they're holding out is, yes, we have some growth capital and we're going to help you grow. And that's a big part of the message. I think it's even Rise Growth Partners in the example of that firm, right? And so very much it's, the acquirer meets growth consultant mindset, even if they're not necessarily full-on growth consultants. And you look at that, and I'm not sure what your take would be, but I'd love to hear from both of you. Where do you see that message playing? How does it fit in the deal-making cycle when firms decide, do I want to go there versus just onboarding with Wealth Enhancement Group or WealthSpire or Cerity that's already got a ship built? What is your view and take on that in terms of the role that sort of entity can play, and how big is it with the growth messaging that's packaged with it? Corey, you're nodding along, so I'm going to give you another swipe at this
Yeah,
one.
I mean, so we've done a lot of, I don't know, 30, 40, 50, whatever, maybe, of these minority investment deals for clients. And we've had many clients who've considered them and chosen not to, right? So there's a couple of things that are unrelated to the organic growth that are fundamental that I'll talk about super quick, and then I'll get on the other side of it, which is this. One is people have to understand, despite the fact that these minority investors are taking a minority position, they get control over big decisions. Okay, they have veto rights. So day to day, they're not going to bother you. You get to run your clients. You can choose who you work with. You hire your employees, right? They might put you under a budget depending on who it is. But certainly, on big, if you want to sell the firm, you want to take on the significant debt, you want to, bring in other owners into the cap stack, they're going to have a say on that. So you got to realize that people have a misconception up front that they're maintaining, total control because they're only minority. That's not the case. All right. So that's a very fundamental thing. The other thing is that some of them make a lot of promises around the way they're going to support the growth of the firm. And, without picking out anybody in particular, I would just say that model is generally stronger in terms of providing capital, and deal, experience and expertise, right? And consulting around inorganic growth. Okay. The promises they make, frankly, around organic growth, around key introductions, around whatever, I haven't seen, I mean, there are a lot of ways, through custodians, through other professionals, through the attorneys, through consultants, to get access to that kind of stuff. So for me, the right, so I think it's important when people are considering a minority deal on why are they taking that capital, what are the implications of it, and what are the alternatives, right? So who is that ideal for in my mind? I've had clients who say, okay, I get it. I'm not going to depend upon any of this other. What I understand is that I understand that I feel like I have an ability to grow inorganically. I need some capital and fuel on the fire to do that. I want to maintain most of my equity so that when I have that growth, I can then, have 80% of the value of that when I monetize it, right? And I wouldn't be able to do that without this capital and some strategic, and deal expertise around that. right? And maybe help with some deal flow. And I've had clients who've leveraged that phenomenally. And by the way, going back, and a lot of them have been the younger, like, the ones who are more mid-career, right? Because their decision is, like we talked about, this cutting off the upside, things like that, and whatever. If you do a full sale deal, and they can continue to to grow, including, by the way, their own organic growth, right? So for me, that's where these folks come in. You got to understand what what you're getting into. I've had people who've regretted doing those deals. But it's like anything else. What's the purpose of it is, what are you giving up in exchange for that? How are you going to leverage that? If you're not going to leverage that growth capital mainly on the inorganic growth side, then it doesn't make any sense. But I've had some clients who've done well with it.
Yeah, and Corey, real quick before Jess's answer, we have a client that's took money from an as a minority stake where they were told first to invest capital in organic growth strategies to further amp up what they're doing. And then when they got that track record going, then they would get more fuel, so to speak, to do more deals. And so it's also something I've seen firsthand when we got hired as a result of that. I mean, right? They said, "Hey, we need a growth partner. And this is what we're going to do." And so I know that's part of the equation. But I know that most of them are baking into future deals into the deployment of that capital as part of why they're getting it. So, Jess, what's your take on this last big question before we get to our part?
I have a lot of opinions on this. So I think the landscape of what is available to people who are trying to monetize some or all of their business has changed dramatically over the last 5 to 7 years, right? So, in the before times, it was kind of like there were a handful of aggregators. You kind of picked the one that you wanted, you did your deal, and you hope for the best. Then, private equity kind of started coming in. They were willing to take majority stakes of larger RIAs. Then that kind of became saturated and said, okay, well, maybe we'll go a little bit downstream. We'll take majority of smaller firms because, hey, guess what? You can triple a $15 billion firm a lot faster than you can triple a $150 billion firm, right? Then that market got saturated. So then the next step was, okay, well, maybe we'll take minority stakes. And we need at least $5 million of free cash flow because otherwise the investment's not worth it if we're taking minority stakes. Now what we're seeing are firms that are like, you know what, we'll take minority stakes of firms between 750 million and 2 billion, and we'll help institutionalize them, right? Like we'll help them figure out their organic growth strategy and we'll help them, put in a C-suite and whatever. And I suspect that that'll just kind of continue to happen to varying degrees of success. But understanding that that is where the landscape is right now, my best advice is that the amount of diligence that needs to get done by someone who's looking to take minority capital is as great, if not greater, than someone who's trying to sell 100% of their business. Because at this point, the 100% buyers have their playbook. They know, what table stakes are. You can't change fees for existing clients. You can't make someone relocate. You can't fire anyone. You can't, there are certain things you just can't do. It's a little bit more of the Wild West still, I think, on the minority investment side. Which is why you as the seller need to know exactly what you're looking for in a minority partner. Is it someone that's going to help you with organic growth? Is it someone who has people on staff who already have experience in digital marketing? Is it because you're looking to crowdsource best ideas from, other firms that they've invested in? Is it because you want to be the first so that you can dictate what they're going to do for you, right? Like there are enough options now where the more you can clarify what you want to do besides take some chips off the table, the better your options are and the higher the likelihood of success on the other side of a deal because you've been able to explain to the minority partner, this is where I want help, right? And then you can look back in 2 years and say, hey, look, you told me you were going to help me with my digital marketing, with my, footprint expansion and in other geographies, whatever. Like, why haven't you done that? Right? As opposed to like, you said you were going to get your hands dirty in my business. Well, like, what the heck does that mean? That's what everyone says. It doesn't mean anything. So I think it exists. You get in what you put out, or you take out what you put in.
So, well, it's a really deep end of the pool to discuss. There's more we can talk about. I'm going to leave this discussion with one final comment about that. We did a study off the back of something else we saw. Saw a stat before one of the conferences I spoke at that I used on stage that basically said 9% of the firms with 5 billion in AUM or more had C-level or executive VP level marketing offers, CMOs, EVPs of marketing, which says there's a lot of you call institutional. I can't even say that word. Institutionalization that needs to get done in terms of the growth leadership of firms, right? But it was interesting. I had one of our business development associates go in, and we took 7 known minority stake investors and scouted out their portfolio companies to see, okay, who are the contacts at marketing? All these firms should, by nature, have more money to market. So let's see if there's opportunities for us to turn over. It was close to 40% of those firms had a C-level or EVP level type marketing person, far surpassing. So they haven't given up everything to sell to a backer, but they're certainly not going it alone. And from that standpoint, the adoption rate of those firms having marketing leadership, growth leadership was impressive. So I think about that in terms of the intersection point of M&A and growth. It's like there could be a sweet spot for firms that are trying to, I think you used the phrase earlier, get 2 bites of the apple, is to find a way to construct a business so you can play at that level, do the right thing, make yourself as attractive as a buyer or seller. So anyway, there's a lot to chew on there. So let's get to our parting shots. This is the point of the show. It's your chance. Quick 15, 30-second takeaway for people to think about, advice you have as it relates to your area of specialization or the intersection of the things we're talking about today. What do you want our listeners to be left with when they think about growth and M&A and things like that, where we read the headlines or think about the way your firms help? It's all on the table. It's your parting shot. You get to go. Jess, I'll put you in the hot seat first. What's your parting shot?
I think if there's one takeaway, it's that there is a partner for everyone. If you have not grown, if you have grown, if you are looking to find a partner, there is a solution out there for you. What that solution looks like is going to be different depending on what you have done with your business up to this point. There is a premium associated with growth, but not at the expense of having built a good foundation of the business in all other areas. As a buyer, the stakes are higher. Your organic growth needs to be robust, easily explainable, and robust again. I'll use that word twice in order to participate in competitive processes.
Awesome. Corey, take a stab. Your parting shot.
So for people who don't know me, they may think this is strange coming from a lawyer. For people who know me, they'll understand. I'm big on people doing internal work to figure out truly what aligns for them, right? And one of the issues, like one of the beauties is, and I've been in this industry a long time, where there were much fewer options. Now there's so many options, so many different things, so many pressures, so many people marketing, calling upon people to set, there's a lot, which can create a lot of confusion, and also can create people making decisions from places that they may regret that that's not aligned for them, right? Because they may be drawn to somebody's pitch. So I think it's really, really important, whether you're looking to sell, whether you're looking to even be a buyer. It's why I ask the why question when I do the whiteboarding sessions, or whether you're thinking about minority investment, to really take a step back as the founder or a founding team and say, okay, what are our values? What do we really care about? Where are we trying to go? What is our commitment? And then what model, which buyers, which investors, whatever it is, align with that, and have that be your driving factor. Because if you don't, you may end up doing something you regret.
Well, awesome thoughts and comments. Really appreciate both of you taking time out. This concludes another episode of Marketing Mashup. Again, Corey Kupfer from Kupfer Law, and we have Jess Polito from Turkey Hill Management. Thank you both for taking the time to be part of the show.
Great to be here.
Thanks for having us.
Thanks for listening to Marketing Matchup, a production of Gregory. If you like what you heard, please listen and subscribe wherever you get your podcasts.